Hello trading friends, and welcome back to Forex Focus, brought to you by tastyfx. Taking a look at the equity market and its recent trip lower, spiking volatility here in the middle part of the year. And we're going to take a look at some traditional safe haven assets and throw a bunch of data at you to either confirm or maybe not necessarily deny, but deny for this current market some of those traditional safe havens that might not be working in this environment, because of course the context is key for any situation, especially this one where we have an S&P 500 market that's trading around its all-time highs, but could be fueled by lower interest rates, and how that plays into the gold market, the bond market, and currencies. Traditional safe havens, all of them, but some might be more highly correlated to a stock market crash than others. First, let's take a look at the stock market data, as it's been a pretty violent move here off of all-time highs. Of course, it looks like a rounding error off of a pretty bullish trend, especially over the course of the last year, as S&Ps have gone from 4,000 to nearly 6,000. But a nice story here for those of you out there who are new to trading or haven't witnessed a prolonged stock market crash. The fact that the stock market can erase $200, $300 here in the S&P 500, or 5 to 10% in a matter of a day or two, whereas when that 5 to 10% is getting built into the upside, it usually takes days or weeks or even months. Just letting you all know that historically stocks can crash a lot faster than they can move higher. And so amid this slide recently, and we're seeing this from a number of angles. Of course, in the U.S., you want to say, oh, all the political turbulence is causing this back and forth the last couple of weeks. But really, global data has been slowing pretty much across the board. And we'll look to more U.S. data and data across the globe coming up. But we're seeing a lot of negative GDP growth rates in places like the Australasian region and also in parts of Europe, that people are now fearful of. Were interest rates too high for too long, and now the backward-looking data that we're looking at is going to catch up quite quickly, and these central banks haven't cut fast enough. We'll see how that all plays out, but definitely worth noting the fact that the VIX, which is really the universal fear gauge, and might be something that sparks people flocking to safe haven assets when it gets to a certain level, is up, obviously, the last couple of weeks as stocks have turned lower. But the magnitude of this move is really starting to get interesting, because we like to say, in the long term, stock volatility and the VIX here, the S&P 500 implied volatility measure, averages around 13, 14, 15% here. And so, 16, 17, 18 is not necessarily the highest level ever, but getting near to 20, that would be the highest in the last year's worth of trading. And of course, going back to the pandemic, when we were seeing 40, 50, 60 handle prints, that would be a real stock market crash. And we've very quickly here climbed from around 12 to 18, like I say, in just a matter of days. And so if the selling continues, this can absolutely turn into a crash mode in just a week or two. So we'll continue to monitor that, taking a little bit of a breather around those highs of 18. Didn't quite get to 20 like we did in the fall of 2023. But we will see, because we're entering that fall period again, and stocks don't really have a seasonality to them. But people do like to point at the fact that the financial crisis really kicked off in the fall of 07 and really deepened in the fall of 08. And there might be something around the idea of summer vacation, people coming back to the market, higher volume in September, October, and November, and potentially profit taking, especially like we just showed, the S&P going from 4,000 to almost 6,000. Either way, we'll see what stocks do. Definitely can't predict the future if this is going to be an all-out crash or not. But I do want to give you some looks at these historical, traditional safe havens and do some debunking or confirming as to whether or not they might be safe havens this time around, because this context is everything. And I gave a little bit of it to you earlier, the fact that right now the stock market is trying to balance, our interest rates, have they been too high for too long, and this contractionary period is just about to set in a big way. And sure, some major central banks have already started cutting, like in Canada, and sure, the US is set to cut interest rates in the coming months, but will it be too little too late? Because 5% plus is obviously very constrictive, and the backward-looking metrics that we're looking at, are we about to get some really bad present metrics? Is the data about to really turn over? And so with all of that in mind, you look at the gold market and the bond market here, traditional safe haven assets, and you think about the fact that interest rates play into this gold market, for example, in such a big way, which is to say that lower interest rates might fuel this gold market, and the fact that lower interest rates right now are also kind of holding up this stock market, the idea that interest rates might be lower soon is definitely has been a bullish idea in the last year of trading. And you think about, well, doesn't that necessarily mean then that gold prices and stock prices might be moving in the same direction? And some similar sentiment there for bonds as well. And we're going to look at the correlations in a second, but just think about the fact that gold around $2,400 is really a rounding error off of all-time highs, and so are S&Ps. And so if I were to be 100% in the stock market and say, hey, I want to hedge some of this, I want to take 20% out of my portfolio and get into a safe haven asset like gold, oh, well, that's also at all-time highs here. Is that a hedge? Especially, I'm sure a lot of you out there like me have seen some of these big down days in the stock market, and they've correlated to some really big down days in the gold market. As you can see, that move from all-time highs in gold about a week or two ago, pretty highly correlated to that all-time high in S&P about a week or so ago. And so we'll look at the correlations in a second, but not really getting that high correlation for a safe haven asset in the gold piece, and bonds, again, so closely tied to interest rates. And you can see that bond market, especially since around March, April, moving higher with gold and with stocks. That might not be a safe haven asset. But let's take a look at currencies, because this is a really interesting one, and one that you have to go deep on to find the potential flight to quality or safe haven. And I want to start with yen. This is a market that has so much going on in its own right. Looking at the dollar yen chart here, of course, you've heard about all of the craziness with this market, dollar yen getting to highs over the course of the last 2 months that we haven't seen since the 1980s. So lows for Japanese yen that we haven't seen since the 1980s. And you're talking about Japanese intervention on the currency in the last couple of months, and the first interest rate hike for the Bank of Japan in the last decade, and that only brought them back out of negative territory for the Bank of Japan. because they didn't hike when other major central banks were doing so the last couple of years here amid the rise in inflation, because their economy was a lot slower coming out of the pandemic than the US and the Euro area. So much context in there. But if we do away with a little bit of that context and just look at the last couple of weeks here of price action correlated with that stock market and gold market printing that all-time high a couple of weeks ago, you do see a pretty distinct trend of yen buying as the stock market and gold market are coming off of their highs. And it does call back, maybe not the last 3 or 4 years of price action where, like I say, you've seen this widening gap of US and Japanese interest rates, and thus some of the greatest extremes in this market since the 1990s and even 1980s. If you do away with that for a second, currency traders will tell you historically, the last 10 years, 20 years, 30 years, Japanese yen has been seen as a flight to quality. Same with Swiss franc. We don't have the chart up there, but you can take a look at that. You've seen some Swiss franc buying the last couple of weeks, some bullishness in there, and some bearishness in the dollar franc market in the same time that we've seen stocks move off of their all-time highs. And we'll take a look at those correlations just to confirm in a second. But I do want to weave in something that might confuse you all, and if it does, just stick on the Japanese yen and Swiss franc side of things. But I do want to take a look at now dollar CAD, so US dollar versus Canadian dollar, just to hammer home that, first of all, none of these relationships are gold, so to speak. They don't stay forever. They're going to be constantly changing, not only with the market environment, but also how you're pricing them within this forex landscape, right? Because you look at dollar yen and you're seeing some dollar selling, yen buying in line with the stock market bearishness. You look at dollar CAD and you're seeing the US dollar pushing right now highs year to date, and looking at some of the highest prices the last couple of years here, and you might say, okay, well, is the US dollar risk on or is it risk off? Is it a flight to quality or is it highly correlated with the stock market? And it depends on the relative performance, right? Because in the list of forex currencies, if you were to rank them by safe haven or flight to quality attributes, you know, your Japanese yen and Swiss franc might be up here, but the US dollar compared to Australian dollar or Canadian dollar might be a flight to quality compared to a more risk-on currency like the CAD, like the Australian dollar. Of course, all of these things can change, but the idea would be, okay, say we have a global recession, well, Japan and Switzerland might be more of a safe haven than the US, but the US might be more of a safe haven than Canada, China, Australia, and you start to get a feel for this concept. Of course, the textbooks will tell you it's just stocks and, gold and bonds. Those are the safe havens no matter what. But the market's going to tell you something different depending on the context. And with that, I want to close with the correlations here, because these are just the hard numbers. This is what we're seeing with the last handful of weeks of stock bearishness. We're looking at 3-month correlations. So this is taking into account the stock market highs that they put in a couple of weeks ago and the last 10 or so trading days of stock bearishness. And what you're seeing, if you look at that first column, is the S&P negatively correlated to VIX. That makes so much sense, right? If the S&P 500 is going higher, then the fear gauge tends to move lower. If the S&P is moving lower, the fear gauge tends to move higher. We see that play out with the negative 0.66 correlation. But look at the S&P versus TLT, which is a bond ETF. Positive 0.39 correlation. Okay, so that's not been really a flight to quality asset. They've actually been moving in the same direction more often than not. S&P versus gold, positive 0.36 correlation. Again, the gold market tending to move with stocks over the course of the last 3 months. And then to boot there, I put in the Euro ETF, Australian ETF, and Canadian ETF, their currencies that is. And you see positive correlations again. But what does that tell you, especially that 0.48 positive correlation in FXA? That's a 0.48 positive correlation Australian dollar to the S&P. Well, that tells you that it's about a negative 0.48 correlation between the S&P 500 and the US dollar when it's paired against Aussie. I know this is a lot to take into account, but this is exactly what I was getting at just a second ago, which is to say the US dollar versus Aussie, or the US dollar versus euro, or the US dollar versus Canadian dollar there has been a flight to quality asset given these numbers over the course of the last 3 months. If the stock market is moving lower, then the US dollar versus Aussie or versus CAD has been moving higher, and vice versa. If the S&P were to bounce back to all-time highs, then that Aussie might get strong again, like we saw a couple of weeks ago. That Aussie was pushing through 66 cents and getting back close to 67 for the first time in several months. And so, again, are any of these safe haven assets always going to move higher if the stock market crashes? No, it depends on the context here. But in the current market environment, you're seeing a positive correlation between stock market moves lower and the Japanese yen, Swiss franc, and the US dollar in certain pairs. And so those might be some of the better safe havens for the current market environment. Of course, this stuff can always change, but also really interesting to see that bonds and gold, not really good safe havens for this type of market. We'll continue to follow the data and the events around the stock market as they play out. Thanks for watching, everybody.